Welcome back. You're watching the special edition of Young Turks. We're in conversation with the founder of India's most valued fintech company, PhonePe. But what's the plan? You've talked about some of the verticals that you feel very confident about. But what's the plan as far as IPOing is concerned? Samir, 2023 was the expectation. The world has changed since you made that forecast. What can we now realistically expect?
So we'd said 5 years to be IPO ready in 2018. And I think if we were just looking at the payments core business, I think we are well positioned enough. Triple-digit operating growth, triple-digit revenue growth, very close to break even on the core biz. We would have thought about it. But you're right, lots changed. We had to spend a long year and a lot of investors had to actually pony up a lot of tax for us to domicile because we decided we want to list in India. So I think that need be done. And shout out to Walmart and all other investors. Almost 8,000 crores in tax, but I'm happy that we are now domiciled here. So you can sort of now definitely say PhonePe will IPO in India. That one part is done. Second, as you probably know, we've raised a bunch of money. We're in the middle of a fundraise, probably close by end of this month. So we're raising up to $1 billion, which I think will fund all of these new ambitions. We want to give it at least a couple of years for these businesses to get incubated to sort of give us a good sense of how big they can get, how much more money needs to be deployed. So at this point, I'd say 24, second half, 25, we'll start looking at the right time for an IPO. Obviously, the market environment also has to change a bit. I don't think it's a good time for tech businesses to go public. And with the money in the bank right now to sort of fund our aspirations, I think we are well placed. We can write this out.
You talked about IPOs and you also talked about valuations, Samir, and I want to understand from you what we saw play out here in India with some of the new listings that we saw, including the likes of Paytm, and that dissonance between private market valuations and finally public market valuations. How have you read that story? What are the lessons that you take away from what we've seen happen there? I mean, today you're valued more than double that of Paytm.
It's hard for me to comment on Paytm specifically, but I'll say this. One, I think a lot of these well-known brands, Paytm, Zomato, Nigam, and others, I think they ended up going public in India when the VC market was at its absolute peak worldwide. And if you see the carnage in the tech industry and the fintech industry worldwide in the public markets, unfortunately for these brands, which are very well-known brands, household names, the hit in India is less than the worldwide hit on tech stocks, but it's significant nevertheless. So I think there's merit to the fact that some of this is a global meltdown problem. I think the second one is the market not liking combination of either governance standards or business models. But again, let's look at where their businesses were a year ago. Let's look at the health of their core businesses today. And I would contend that while they sort of broke the wall and went public first, they got hit by the market, they're turning around fast. And I'll give this shout out to a Paytm. I think the business looks fundamentally more healthy today than it did 4 quarters ago when we look at it from a distance. So maybe the markets help the players grow up fast fiscally as well. It's a good thing.
You spoke about the course correction that we've seen in the ecosystem as companies now focus on profitability. Now, what we've also seen happen globally at this point in time is a significant shake-up with the large players cutting down on costs, letting go of people. And of course, the era of zero interest rates is over for the foreseeable future. What will be the implications of that for India, for the Indian startup ecosystem in the near term? We've already seen many of the edtech companies laying off and so on and so forth. Do you see that we're at the start of a painful cycle that we will see play out in India as well?
I think India saw, and unfortunately, saw a bunch of correction during COVID, where people just had to actually downsize because a lot of the startups in India are still very nascent. The ecosystem is nascent, and It's equity funded, not profit funded. I do think, however, it's very different than the large big tech platforms in the US doing massive layoffs worldwide. In part, honestly, as an entrepreneur, I find it a little obnoxious because these are very large, very profitable companies with very large ambitions. They're investing in the ambitions, but they're laying off the people. So I personally don't subscribe to it. I'm glad that the Indian founders are not following suit that way. I think as a market overall, also, I think we're a little more empathetic. I'm not for protectionism at all, but I also don't like sort of this perversion between record profits and record layoffs. I don't understand that one. I don't think India will do that.
Well, we certainly hope so. And I have to say that I tend to agree with you. At least I'm still yet to understand fully why we're seeing this play out, record profitability, and yet the kind of layoffs that we are seeing with these global tech companies. But before I let you go, Samir, I mean, you've been around, you've seen many cycles, you've built a sustainable business. To many startups who are watching and founders who are watching who haven't been on the rodeo for as long as you have, what would your advice be to them?
I think 23, 24 years into this sector, a couple of rules that have worked consistently. Culture trumps business cycles because you can ride out whether it's a COVID or it's market conditions. I think you can ride out bad market conditions if you're consistent in your culture. Don't let market cycles distort your culture in the down cycles. And I'll give you two live examples of where we've seen this work for us. COVID, when most people started laying off, we actually said we're not going to lay off anybody. We are super proud of the fact we've never done a layoff here. And the company reciprocates, because right after that, when everyone was saying, let's work from home forever, we told everyone, hey guys, we need you to come back into the office. That's when we had a collective best. And 98% of people are back in the office. So I think if you do right by people when the going is tough, everyone does right by the company. And puts the collective before the individual. I know it's old school, but it still works, guys. And I think the second is you have to be able to say no to your investors, especially early stage, if you're feeling bullied to grow at any cost, because it's very high to fix your margins when the burn's at its peak. It's much easier to grow a little slower. And we've done that. I mean, people are talking about a market cap on UPI today, but fact of the matter is that nobody gave us a chance for the first 4 or 5 years, and we were still growing at the same rate. We've never had 1 year where somebody can say, oh, they broke out, or 1 year where they really did badly. It's a journey, and save your chips for when they matter the most.
Well, Samir, I have to say it's been a pleasure speaking with you. Thank you so much for not just talking to us about your plans with ONDC, but more importantly, taking us through what the landscape for the fintech business in India is likely to look like over the next few years, and also sharing the do's and don'ts that I hope entrepreneurs are listening to. But thanks very much for your time. Appreciate it, and we wish you and your team the very best of luck.
Thank you, Shireen. Pleasure.
Well, with that, it is time for us to wrap up this edition of Young Turks. From all of us here on the program, goodbye and many thanks for watching.